Welcome to Module 3, Chapters 8 and 9 of Women in Finance. Today, we will be delving into the intricate relationship between the economy and investments. The overall economic performance of a country significantly impacts all investment classes. This goes beyond just influencing stock prices, which is why investors should keep a close eye on economic variables to make informed decisions. Let's start with Gross Domestic Product or GDP. This is the total income produced by a country. In 2021, Pakistan's GDP was $348 billion. GDP growth, which means overall business growth, also impacts stock performance. Pakistan's average GDP growth is around 3%. Stocks tend to thrive when GDP is on the rise. Next up, inflation. This is the rise in prices of goods and services. In Pakistan, the average rate of inflation is around 10%. Stocks of companies with strong consumer demand can pass on the impact of high inflation environments. Gold also tends to perform well in inflationary times. Next up, the exchange rate. Depreciation in the exchange rate can lead to higher inflation and impact businesses which rely on imported inputs. However, exports can also become more competitive, which benefits companies which have higher exports. Lastly, interest rates. The rate of return offered by the government of Pakistan when it borrows money from the market. Governments may raise rates to curb inflation, impacting stocks and bonds differently. Investors can lend money to the government using national savings certificates or bonds. Bonds tend to perform well when interest rates are high, whereas stocks shine when rates are declining. This is due to various factors, including people preferring higher risk-free rates during rate hikes and a slowdown in economic growth, which hurts corporate profits. Let's look at a chart illustrating some key macro variables affecting investments. Now, let's move on to Chapter 9, Active versus Passive Investments. Two strategies that investors employ in the ever-evolving landscape of finance. Active investment involves investing directly in individual stocks. Investors can therefore conduct their own research or enlist the expertise of fund managers and financial advisors. Esteemed investors like Warren Buffett, Sir John Templeton, and Mark Mobius follow this approach. On the other hand, passive investing has gained popularity, especially in the last 2 decades. Investors opt for exchange-traded funds, which are actually a basket of stocks. This approach, popularized by John Bogle, founder of Vanguard, is cost-effective and provides diversification. Vanguard is now the largest asset management firm in the world. So whether you opt for active or passive investment, it is really necessary to know the different strategies and economic variables that will impact your investment choices. So until the next lesson, happy investing!